Okay, and good morning, good afternoon, good evening, depending on where you are in our world. My name is Michael Filighera. I am with logicalsignals.com and tradershelpingtraders.com. And my presentation today is basically going to be on nature's law. And so we're all talking about Elliott wave and the Fibonacci sequence, and nature's law actually deals with both, um, but it's more set up for Fibonacci and how we look at both of those. And let me just see, interest law presentation. And if it'll open it for me, come on, open it. Thank you. All right, so let's see, there we go. Again, R.N. Elliott wrote several different things, and I've got my chart up. Let me go over to a different chart, which is going to be my long-term chart on the SPX. And I'm going to flip and go all the way out to my, maximum monthly chart. Okay, move that out of the way. So I think several times we've always talked about what the basics of Elliott wave is. And so now what I'm trying to do today is that much pretty everybody already understands. And so I wanted to talk about R.N. Elliott himself, and that we have to understand R.N. Elliott was an accountant, and he had a problem with his lungs. And so he had to move to California to heal. And while he was here, since he couldn't work, he started to follow the market. And at the time, it was the Dow Jones. And he started to notate by keeping a chart. Now, when I first started doing Elliott Wave, I was on a trading floor. And every hour, I would take out a card from my pocket and I would write down the price of the index and then go home in the afternoon or evening and I would create a chart by putting a pencil point and then connecting the dots. And so you can imagine that how big a chart would be if I'm looking at something from here for the SPX. This particular chart that I'm showing you goes back to January of 1928. So that's a lot of data. That's an awful lot of data. And when I was doing it, I put it on big pieces of graph paper. And if I really wanted to get a long-term picture, I had to stand at one side of my house and go all the way down a hall to the other end of the house, just putting them side by side. Thank God we don't have to do that anymore, that it all gets put into a computer. So anyway, R.N. Elliott developed the Elliott wave theory in the 1930s. And then he published a book called Nature's Law in 1946. And if you've read it, that's great because it's extremely interesting. And really what he says is that the core idea behind nature's law was that the universe, nature, and human activities follow cyclical patterns. Now, this is important. And so the financial markets collectively reflect human psychology. I mean, if you've heard some of my presentations before, really what Elliott Wave is just charting human psychological responses to financial things in the market. And so what Elliott ended up doing is that these cycles, right? So we all will run through a cycle. We started to express those, or we start to label those, and we call them waves. And so underlying all of that structure, it is linked to the Fibonacci sequence. And so, the Fibonacci sequence is nothing more than you start with 0, and then you add the next number. So 0 plus 1 is 1, 1 plus 1 is 2. So the sequence goes 0, 1, 1, 2, 3, and then it starts to grow. 5, 8, 13, 21, 34. And so you're just taking the number and then adding the previous number, and that gives you the next line. And then you keep adding it, it keeps growing and growing and growing, and it's infinite. That number could if you put it through a computer, it's still going to give you Fibonacci numbers to infinity. So what we started to realize, or what Elliott started to realize, that there were relationships between what he was labeling in a wave pattern as 1, 2, 3, 4, 5. That's the impulse, and then an ABC or three waves in the opposite direction. That's the correction. So the complete move would be a total of 8 waves back then. Now, of course, they're different because we have extensions within all of these. Like this is a big extension. This was an extension. This is also a big extension here at the end of this move. But what's important to kind of keep in mind is that if you're counting correctly and you're counting in degrees, then you can put together along with a Fibonacci sequence so that you can understand where markets should come back when they start to correct. So what is most common then, and then what was developed is what's most common for a wave two, what's most common for a wave four. How do we relate wave one and wave three? They do have a relationship. How do we relate wave one and wave five? They do have a relationship, as does wave two and wave four. So again, being that they're all cycles, we have all of this built in. So what we're talking about here is that the Fibonacci ratios, that also was developed. So to start, it was 0.382, 0.5, 0.618, 1, 1.146, 1.236, all of the variations of the sequence. And what Elliott did is that he understood and he realized that waves often retrace or extend within a Fibonacci proportion. So in other words, a Fibonacci ratio. And for example, we have what we would think wave one. We can put up the Fibonacci to see what the expectations might be for wave two. Most common in a wave two is 50 to 62%. So it retraces 0.50 to 62%, but it starts at 0.382. So we have these common Fibonacci levels, and then from there we can build. Now, I will say, within the last few years, with the introduction of quantitative trading, and now everything is algorithmically controlled. One thing that I know the algo programmers have put into their systems, as far as fib numbers, is 0.882. I sit there and I look at them like, well, that really doesn't match anything that I would understand, being an old timer here with Elliott, but it is in the sequence, and therefore it's valid. And I include it now in my own analysis because it is programmed into algorithms. And so when an algorithm is running in one direction or the other, you will find that it'll go to 0.882, and then its multiples above. So you have 0.882, then you have 1.882, et cetera, all the way up or down. Now, so when we think about nature's law within human behavior, so mass psychology, which we all are a part of, it drives collective market movements, right? And basically, as I've always said, we got two basic emotions in the market: greed and fear. Now, both of those are pretty powerful, and both of them create moves that can be very powerful. So we have optimism and pessimism, basically, right? Greed, fear, optimism, pessimism. And they alternate in waves. And these patterns repeat themselves and at a time across all of the time cycles. So in other words, we have a 5-minute chart, a 50-minute chart, a daily chart, an hourly chart, 4-hour chart, same thing. Patterns just really repeat themselves. So when we're going and stepping outside of finance or stepping out of the markets, and we're still thinking about nature's law, we're still thinking about the Fibonacci sequence, this really came about because Elliott started realizing, when he started putting the sequences together, that we can find it. We can find it in nature, everywhere, right? So fib numbers, 3, 5, 8, those are all fib numbers. And then, so really, when you break it down and you go, uh, what is the Fibonacci relationship between 8 and 5? What is the Fibonacci relationship between 3 and 8? And that's how he built this whole sequence of, well, how far does it retrace? What do we have? 0.382, 0.50, 0.618. All right. And then how all that fits in. So, but we also can look at, let's just all take a look at our human body, take a look at our bodies. What do we have? We've got 5 senses, right? We have 3 major parts of our body: our head, our torso, our legs. And then what happens when we start to break that down? Within the torso, we have 2 arms, we have 2 hands, we have 5 fingers on the hand. If we go, each finger has 3 joints. All the way up to the shoulder are 3 joints: wrist, elbow, shoulder. So again, 3, 5, 3, 5. We start to get that repeating itself. Here's one better. Our face is set up in a Fibonacci relationship. When we look at the nose, that's the center. Our eyes usually are centered 0.382 either direction. So we might notice that somebody might have a little lazy eye or a little cross-eyed. And you know why? Because it broke the Fibonacci. And so our minds are developed and accept that when we look, we're looking in a Fibonacci sequence. We're looking at the body as if we've got this perfect sequence going. So when it breaks somehow or some way, it's drawn to our attention. And it isn't something that, like, we're being rude or whatever. If we see somebody that might be cross-eyed or something like that, we're just drawn to it because it gets triggered in our brain. So, and this is all real. So, and then you're going to find this over and over and over again in nature. Example, a conch. Now that's a Fibonacci arc, right? Where you're starting and it just builds and it goes and it goes. And now if you start to measure between each one of the circles that go around it, right? It's usually about 382. And then up 1, you're going to be at 618. Then you go up 2. From that center, it's going to be the next level up. They're perfect. That's nature's law. Now, here is what Elliott actually said that makes total sense to me. That we are human beings. We are subject to nature's law. And there's a lot of people, oh, no way, no way, I don't believe in all that. That's all airy-fairy, hokey-pokey. It's like, no, actually, it's the way we're constructed. We can look at things, piece of broccoli. Take a stem, pull it off that broccoli stalk, and look at it. And look at how it grows. It grows up, it separates, it puts 3 stalks, and then that separates, and you got 5. And then it separates, and each time it follows the Fibonacci sequence. And a snowflake, perfectly built, and believe it or not. So all of these things we find in nature: shells, conches, cycles that we have in the weather, cycles that we have in the ocean, tides and the gravitational pull. It all kind of happens by nature's law. And I find that to be very, very, very interesting. So the foundation of the Elliott wave theory really is nature's law. And so we can go on and we can now talking about the Elliott wave principle. And now I can really make reference to my chart. So market moves in a pattern of 5 waves up, 3 waves down. So here, for example, my long-term count for the S&P is basically that we're getting ready to finish cycle wave 3, right? That's what's going to finish up here. What's inside of cycle wave 3? 5 waves of primary degree, of which we're in primary 5, right? Comes in 5 waves up. So the cycle to finish cycle 3 is going to be 5 waves up of primary degree. We're in primary 5. And because Elliott is designed as they're like stepping stones. They're steps all the way. So within cycle three, we're going to have primary one, primary two, primary three, primary four. What's going to be inside of primary wave five? Five waves of intermediate degree, right? Follow my degrees. Grand supercycle's here, supercycle's here, cycle is here, primary. So each time you go down, I'm down in primary. I got to have five of them. Well, I'm in the primary fifth. Well, what's cycle? What's one down? Intermediate, which is the yellow. What's going to be inside this primary fifth wave? Five waves of intermediate degree. So you can see stepping stones, right? Steps. So what's inside intermediate wave three? Five waves of minor degree. What's inside intermediate wave four? Five waves of minor degree. Now I can bring this down real quick, right? Now we're inside here. So we have three, we have four. And what's going to happen now? Now we're basically putting in five waves of minor degree, of which we've done one through four. So you can just map it out. And now you're going to get a clue. It's like, okay, we're getting closer and closer. Now, granted, you have to kind of be paying attention to how you're counting, right? Because again, when under Elliott, what do we have? Well, on an impulse, simple. It's five waves, followed by three, and then five waves until the cycle finishes. And then we know that it's going to be an intermediate degree finishes that we're going to get a correction, right? We have intermediate wave three, we have intermediate wave four was a correction, all three waves. So then we have another five. So every time we have a wave two, three waves. But then we started to get a little bit more complex. And so we started to realize, or actually it was Elliott started to realize, and then followed up by Robert Prechter and A.J. Frost. When we started to find out that's like, well, you know what, there's a lot of variations that can come in. We have impulse, one, that's it. 1, 2, 3, 4, 5. That's an impulse. But what about the correction? Well, the correction can take between 11 and 13 different variations. It could be just an ABC, zigzag, which is a 5, 3, 5, which is what this was right here. Or it could be a sideways move, which would be, let me go, I got to break this down so you can see it. I think I can do it here. I got to go out one more. I can do it here. That's a diagonal triangle. So, and it's a running fourth wave, which is even a more rare pattern under Elliott. But you can see instead of just getting the normal ABC, it breaks basically into five, but they're labeled A, B, C, D, E. And then there are other requirements within a triangle that the market or just the pattern needs to meet in order for it to be successful. And what I always have found so interesting with Elliott, a lot of people, they want to count something. It's like, don't break any of the rules. There are basically, I think, 4, maybe 5 rules that you just don't break. And some of them have to do with corrections. And if you do kind of break them, then your count's not going to be as accurate as you think it is. If you break a lot of the rules, such as, for example, wave 2 cannot go past the starting point of wave 1. If it does, then it's not a wave 2, is it? Because wave 2 corrects wave 1. Wave 4 corrects wave 3. So what happens if wave 4 comes all the way down, right? Like here, because where does wave 4 begin? Or wave 3 begin would be here. And then, so we found that in a triangle pattern, right? If it's, and it could be a diagonal, which you count 1, 2, 3, 4, 5. And wave 4 can overlap wave 1 in a triangle. So it's learning all the details, but understanding, well, when does it constitute that wave 4 can overlap wave 1? If you're counting in an impulse. If you're counting in a diagonal, you're still counting 1, 2, 3, 4, 5. But first of all of your waves, all 5, will be 3-wave affairs. Instead of wave 1 being 5, wave 3 being 5, usually extended, and wave 5 being 5, with waves 2 and 3 being ABCs or a variation thereof. Now, this is kind of important because we get stuck in 118 is saying each having a 5.55% probability. Each wave pattern, Matt is making a statement, each wave pattern. So in any case, I think that when we're adding Fibonacci to our particular count, because we're trying to determine what can we expect coming next. For example, I got 1 and 2 complete, and now I got to map out this third wave, which, by the way, went all the way up to here. So you already know that wave 3 will be 5 waves all on its own. But we also know that normally that within this 5-wave rally or impulse, wave 3, normally the longest and the strongest, and also the one that's going to subdivide. So it's going to create its own 5, and usually within the third of that third wave, it extends even further. It doubles down, you could say. So wave 3 of 3. So I don't know how many times you'll hear from an analyst or even me if you're listening to my own work, where I'm saying we're in a 3 of 3 of 3 move. For example, I can go back out to that monthly maximum, really. So we're in cycle wave 3 of super cycle wave 3 of grand super cycle wave 3. So on a very, very large level, since 1932, or actually since 1949, we've been in a 3 of 3 of 3 move. And we're just finishing the cycle third. So what comes next is a cycle 4. And then after that, a cycle 5. And when that's done, then we have super cycle wave 3 will be complete. So you'll also hear me say when I'm giving a big picture update, this bull market has a lot more to go. Now, that doesn't mean, maybe we're, and basis the Dow, or even let's put it basis the S&P, 10,000, 15,000, very likely. But before we get to any of that, right now, we're going to go through a cycle fourth wave. And when we hit that cycle fourth wave, thank you. Thank you. Fib 886. Okay, so that's great. Thank you so much. Oh, well, thank you. I appreciate that. But actually, it was 11 to 13. So redo your probabilities with that in mind, and I think it'll be more accurate. And thank you, Ashkal, for putting in the 88.6 or where that comes from and how it is. And it is amazing. All right, so back to what I'm talking about. So here we are. We're in all these extensions, and each one, so this longer term, but we're getting ready to finish cycle wave 3. So, and this is just basically following what Elliott left for us. So we're getting ready to go into a cycle fourth wave. Right off the bat, we can go back and we can look and say, well, you know what? On a cycle fourth wave, as Elliott left it for us, a fourth wave underway will find its terminus or its endpoint within the fourth wave of one lesser degree. Well, guess what? We're up at a very higher degree. This particular third wave started in 1949. So it's been underway for 76 years. That's a long time. And so to correct it, when it does correct, we would anticipate or expect it to go back to the fourth wave of one lesser degree. And that's why I've put this in a box and I put a green on it, because that's my key for the primary degree. Cycle degree 4 will find its terminus, its endpoint within primary wave 4. All right. And guess what primary wave 4, now, just to get back on this large bull market that we've been in forever, right? All my lifetime. And probably after I'm gone, it'll continue for another, while, which is fulfilling the concept that Elliott wave truly building blocks. And Elliott is the one that came up with Grand Supercycle. He marked these on his original works, and that's where I started. I thought, well, he's the master, he's the author. I'm going to go from what he said. And he put 1, 2. So knowing that we're in a third, what's going to be in there? 5 waves of supercycle. Okay, I got to count out 5. 1, 2. We're inside the third. What is inside that supercycle wave 3? Going to be 5 waves of cycle degree. I got 1, 2. Okay, so I'm in cycle wave 3. What's going to be inside of that? 5 waves of primary degree. And when I get done with primary wave 5, which I now can go down, right? So what's inside primary 5? 5 waves of intermediate degree. Now we can continue to forecast and to look. I've already discussed, right? For wherever this ends, I'm going to run fibs, and I pretty much will guarantee you that wherever it ends here in the S&P, whether it's going to be 67, 68, which is kind of where, or 58, which is where we've been, or if it's going to be 7,092, or if it's going to be 7,100 or 7,200, doesn't make any difference. I will run a fib from there all the way up to wherever it ends. And I want you to know pretty much where 0.382 is going to come in, right here, within this box. It's just the law of nature. I can't explain it outside of that. But the way that the things are constructed, the way that the markets move and follow such clean such clean Fibonacci sequence, that that's why you see them repeat and repeat and repeat and repeat. Why? Because it's the law of nature. So again, Elliott, impulse waves 1 through 5, they move in the direction of the trend. But people say, well, what happens? The trend is up, but we'll get 5 waves down in a corrective pattern. We sure will. Right? And on a major turn lower, right, which we're kind of getting ready to do, if we start to come down we have cycle wave 4, what's going to be inside of cycle 4? 3 waves labeled ABC of primary degree. Well, if we're looking at primary wave A or a wave of any correction, what are the possibilities? Well, if it's going to be a zigzag, that's going to say 5, 3, 5. So in other words, A is going to be 5, B is going to be 3 waves against the trend, and 5 is going to be down, but it's a C wave. And what are one of the rules? All C must be 5 waves. Even if wave C is going to form a diagonal, it's still going to count as 5. It's just that all the internal waves will be 3s. So this is some of the complexities of Elliott, but once you can get them and understand where they occur, you'll know what to look for. Impulse is pretty basic. 1, 2, 3, 4, 5. In the direction of the trend. Corrective waves, ABC, and they move against the trend. So we can go on and on. So that's the foundation of the Elliott wave theory. So a classic Elliott complete move, and they even called it that, are 5 waves, then 3. So what's the total? The total is 8. But we can then go inside and realize that you're going to have a lot more wave movement. So there's wave, but the basic, if we count it, we've got that this is 5, and then we had 3, so that's 8. So that was a pretty much complete move. And first of all, to start it from there, 5, 3, that's 8, and it label it 1, 2. You do another 5, 3, then you got 3, 4. And then this last one will complete the cycle, right? Because that'll be 5. Now you're starting over, but what we're correcting is from there. Still going to be, because what do we have? Wave 3, 5 waves. Okay, so we got to have 3, but it's on a larger degree. So you see, as you build upwards, as this thing gets bigger and bigger, so will your corrections. So even if I'm just looking when I got here, We had to have a primary four. I think if I go back and I really start looking at the inside of all this, you're going to find where this fourth wave probably came back down towards or into the territory of the intermediate fourth wave inside here. And it'd have to be, that's likely it there. And it went a little bit beyond, I'm sure. But again, this is like a monthly and it's multiple years, so it's hard to see all the internals. But here, my other point is, even though I'm calling for a larger correction, and it's going to stay within a very, very long-term bull cycle, which is not over. Well, what's inside of that? Let's go back to here. What's inside? What kicked it off? The depression, the crash of 1929 and the depression that followed. That's what kicked off this five waves that formed one and two. And then this is just an extension of the, all the hard times. So it wasn't until this is after the war and we got into the construction, whatever, and then that provided the impetus for the recovery, for all the different things. But what's inside of here? Well, we can look at this. That's the 70s. What happened in the 70s for those of us that were around? Stagflation. Didn't move at all. It just kind of sat and did nothing and just got less and less and less. And so, we didn't have a depression, but we had deflation. So the volume dried up. And then we recovered. Then we got out of it and we started to recover. I want to show you this right here. See that little box right there? That's the crash of 1987. I was there. We all thought the world was coming to an end, and I'm not joking. I was on the Pacific Exchange at the time, and 1/3 of the capital on the floor, so all the market makers, 1/3 of the capital of the floor got wiped out on that little tiny move. Okay, we recovered. What happened in here? This was a normal A wave down, so we're looking for the larger correction. But remember what this was? That's the great financial collapse of 2008, 2009. Look at it on this big long chart. But again, I was there, and I imagine many of you were there. It was intense. We saw bank failures. We saw brokerage house failures, so merchant banks, right? We saw Bank of America almost go down. We saw Wells Fargo almost go down. We saw Lehman Brothers shut the doors overnight. We saw Bear Stearns shut the doors overnight. It was pretty intense. How do we get out of that? Well, stimulus. We had to bail out all those corporations so they could keep all of us working. That started. All right, so that's that one. Doesn't look all that big, does it? But boy, when we were in it, it was intense. See that right there? That's the pandemic. You all remember that one? I traded it. It was pretty intense. Again, why? Unknown. Bail out. Get your cash. We can't leave our houses. What was the resolve? We need to stimulate individuals. So we got stimulus checks, and we got several of them. And people needed to be bailed out so that we could continue to live and support our economy. And it worked. But it added a lot of money to the national debt. And that is now what's plaguing the United States is the debt. And we're adding to it pretty often. So what I think this is the national debt just skyrocketing exponentially, just kind of going and going and going without stopping. So really, what are we correcting? The last 16 years of excess. The last 16 years of low interest rates, printing tons and tons and tons of money, spending tons and tons and tons of money, that now needs to be corrected. You all can do the math and figure out how does something correct like that. Well, you can forgive a lot of debt, or you could just collapse. If we think about it, like, what if nobody wants to buy our bonds anymore? They don't want to buy our debt because they don't have the good faith and credit of the United States. They don't believe it anymore. What happened? We will sink. So there's a lot of things that could happen here. But trust me, I'm just saying we're just going to correct the excess here. So I would, and I have said, in the S&P and in the Dow, when it does correct, the potential is for it to drop back to the 2009 lows. And I got to tell you, the flack I received because of that, the amount of people that says you're crazy. I'm like, no, actually, I'm not. I'm just using. Um, one second, I'll answer that question for you. Yes, yes, it is. This particular chart is on log scale, Raj. So it definitely is log scale. Um, and just for SR 555111, do I believe that the USA will do a debt default after the government shutdown? First of all, we don't know if the government will shut down. We've been real good about getting right to the brink, and then they don't. But I don't think that that shutdown would uh, be a forerunner to defaulting on that debt. Defaulting on that debt would be really bad, really bad. I think we can go through this large of a correction without defaulting on the debt. I think it's like what can happen is there's so many other things involved and revolve around it. What happens if the dollar continues to sink? Which, by the way, when we look at our charts, it kind of is suggesting that. And again, all I'm doing is you, oops, wrong chart. All I'm doing is just following Elliott dollar index. I'm in a primary C wave down. And within that primary C wave, I'm in intermediate wave 3 down. And looking like I'm going to be heading for 94. But actually, I got room to go all the way down to 91. And that just finishes wave 3. And then I have a 4, and then I have a 5. So really, in essence, where can all of this come? Where can this primary C wave take us? Below that level. And that is, folks, the 2008 dollar low, which is 70.698. Now, does that mean the end of the world? I don't think so. Does that mean the end of the United States? I don't think so. 2008, we're all still talking. We're all still here. We're all still trading. So do I think it's really going to wipe us out? No. But I think there will be a lot of changes. I think that the way out of that, I think initially interest rates will have to go up, and that will start to really uh, pull dollars back in, right? Because we're paying higher interest. We're going to need to pay higher interest to attract uh, investors to come back into the U.S. because we need the money to operate the government. We need the money to do things. But things are going to have to change within the government. And whether we want to do it or not, nature's law can do it for us. Elliott wave in combination does it for us because it suggests it. Everybody, we can sit there and say, nope, never going to happen. Nope, never going to happen. And here's a great example. I can go sit in my car and say, I sit in my garage and keep telling people, I'm a car, I'm a car, I'm a car. And I'm not, right? So to say that never happened and never happened, there's too many bullish things going on in the world. That's if you believe all the hype, right? What's behind the curtain? And that, to me, is what Elliott and Fibonacci present to us. Whether we choose to believe it, right? Because we have this concept about, well, AI right now, AI is going to save us all. Is AI a little bit overbought? Is it overvalued right now? And what really is going to happen when AI takes all those low-level jobs and replaces them? They replace the human beings. So what's going to happen then to employment numbers. What's going to happen when the government, because their function is going to be, we have to take all those unemployed people and we have to retrain them so that they can have a job and earn a living and support their families, etc. That's how our economy goes. But if we're going to trust in everything into artificial intelligence, which, by the way, I can't stop it, right? And there are a lot of functionality within it. I use it. I use it every day. You know, it's artificial intelligence and continues to tell me that within the fourth quarter, we should expect a surge in our equity markets, a surge higher. So we're not that far away from 7,000 in the S&P right now, right? So when you think about it, well, that's not we're almost there. Well, consider that it can go to 72 to 75. What's going to propel it? I don't think good news is going to come out. Yes, in about 3 weeks, we're gonna jump into earnings. Do we really think that the third quarter earnings are going to really blow the doors off? If the second quarter didn't and the first quarter didn't, they weren't bad, but they have to continue to factor in a lot of different things, a lot of different things. So let's get back to the conversation because can we use it here, right? We've got the Elliott connection. Now, what about this Fibonacci connection here? So we have the ratios 382, 0.5, 0.618, 0.786, 0.882, 1, 1.382, et cetera. We can build and build and build. And you can do the math to get all of your levels, right? I've got them here. So, but we configure what is most common within these wave patterns. So if we're looking at 1 and 2, what is most common for a third wave? 1.618. If we look at what are the characteristics of a third wave, the third wave is the longest and the strongest most often. And what's the rule? The rule is that wave 3 can never be the shortest wave between 1, 3, and 5. Doesn't have to necessarily be the longest, it just cannot be the shortest. So if you're working a count and your wave 3 is shorter than wave 1, you're running a very high risk that your count is wrong because wave 5 can extend, often does extend, and therefore will come in longer. So again, if you follow my work and I'm counting a third wave, I say, well, there's the 100%, but I'm always looking for a little bit more. And here's why. I don't want the pressure on my count, or I don't want the pressure on wave 5 that it can't be. If I'm going to count wave 3 to be shorter than wave 1, that puts a lot of pressure on your count. And if we're in a significant move, I can tell you right off the bat, more than likely that fifth wave is going to take out that third. And then your count's wrong. So, and there's a lot of cures for that, but I'm just saying off the bat. So what we have. So what I want to add to here on the Fibonacci connection, that the wave patterns often retrace or they extend to Fibonacci proportions, as I just demonstrated, within a wave 3. When we're counting, we're looking at wave 1, we connect wave 1 to the top of wave 2, in this case, because we're going down. And then what's the most common? 1.618. Well, look at where that is. 85. 85. And right now, I'm just looking at a minor. I can bring it down. Let's go here. I'm just looking at the minor 4, right? So we've only equaled. What's minor 4? Well, I got the 5, and it could be 100%. We've already gone through it. And that would be equality. Where here's wave 1 over to 4, equality, the fib relationship between 1 and 5. As the most common is equality. Next up the line is 1.618. And that's 94. So you just heard me before, I said 94. That's why. Now, what do I got? On the intermediate degree, well, I got 100% at 94. Well, I'm going to want more. So maybe it goes down to 91, where wave 5 is 2.618 times the length of wave 1. Still totally acceptable. Wave 5 is not going to be longer than wave 1. which doesn't matter. It could be because wave one is the shortest wave, obviously. So you've taken care of that, but here you're looking for that, but I need more. Well, actually, more would be 94. More would be 94 and a half. That puts that third wave to be the longest wave. That's all I'm looking for. But you can see it's like, what do the numbers show you? Well, the fibs are showing you in the relationships that we trust that the dollar has a lot more to go to the downside. But look what we're doing. We've been farting around up in here forever. Well, that's okay. A lot of things go around the dollar. There's a lot of reasons the dollar trades where it trades. It's the international currency of trade. There's a lot of needs for the dollar, for trading in gold, for trading in crude, for trading in a lot of different things. You got to have dollars. Trading within our treasury market, you got to have dollars. So those countries that are coming in to support the United States by purchasing the debt, receiving interest on it, but purchasing the debt, well, they got to convert to dollars because that's what they got to go buy those bonds with, dollars. So again, there's a lot of functionality to why the dollar sits where it is. But over time, it is looking a little bit soft. And I would say that that's the 3 year. Let's go to the 5 year. Oh, that's the 20. Too much. 5 year. You get a little bit more data. So we have that C wave. So 1, 2, 3, 1.608 is 85. So again, goes through 100. Technically, yep, it could go to 1.618. What could drive the dollar down that quickly? Think about it. A lot of different things. And I like what somebody mentioned. Well, do we think that we could have a debt default? I I really hope not. I really do. I think we could have some problems with the dollar. I think the dollar could go down, and that's going to present its challenges to Bitcoin, to a lot of things that run much smoother on a higher dollar. So when we look again at the Fibonacci connection to all of this, it's solid. And I've been studying and using and publishing my analysis via Elliott wave and Fibonacci since 1990, actually 1991. I learned Elliott in 1989. I began publishing it in 1991, and I've been doing so ever since. I've only made adjustments to what fib levels I use because of the algorithms, because of quantitative trading. I don't have a problem with quantitative trading. I don't have a problem that all the markets operate on algorithms. We can make our adjustments to what an algorithm does or doesn't do. But, and if that's part of the adjustment, I'm doing it. And you know why? Because algorithms go to it. Okay, well, if that's what they're going to do, I'm going to include it. Previously, it was human beings that made the decision, and we ran to the fib levels. It was literally almost picture perfect. Why? Because we are under the rule of nature's law. We cannot escape it. We're part of it. So therefore, we follow that law. Therefore, the markets are truly controlled by human emotional reactions, human emotional responses, right? But now we've programmed an algorithm to make the response for us. Case in point, we get a number. And everyone wonders, like, how did that happen? That, it's an algorithm that takes in that number and plugs it into the if-then statements, right? Or the programming. If it's this, buy. If it's that, sell, and how much, right? If it's up by that much or down by that much, do this. And that's what happens. And they do it in a split second. So those things are the changes that we have. in our marketplace. I don't blame algorithms. That's just the way it is right now. I don't blame quantitative trading. I use it. So these are the things that we need to do. Now, who programs those algorithms to say if it's that, buy it, if it's that, to sell it, if it's this, sell it even more, right? A computer. But is it emotional? Yes. Because a human said, oh, if it's that, that's bad, that's negative, go further. So we still have that human emotional reaction in our trading. It's just a little different and it's presented to us differently. But how many times we're sitting separately, right? But I'll get questions. You're always bearish. I got that one for years. You're just a perma bear. It's like, no, actually, I'm not. I'm just following Elliott, and that's what it's showing me. Well, the market's going against you. It's like, well, then maybe I need to adjust my count, which happened after 2022. Caught that bottom, but I thought it was going to be a B wave back up. I didn't realize that it was. Nope, it's a third on a big degree. So, but even when you're using Elliott, you've got to have points where your count becomes invalidated and you've got to be able to change it and you got to do it quickly. Otherwise, you're screwing yourself and anybody else that comes in with you, if everybody's following you. So it is actually what we do. So Elliott believed that all of this reflected the universal order, and it really does. So do we find nature's law in human behavior? I just said, yeah, we do. We definitely do. So mass psychology drives collective market movements. Yeah, it does. Well, we're all bullish. Oh, gotta go. I.e., that we've got a great, change in yes, SR being asked. Can these methods be used for intraday trading for the SPX and NASDAQ? Yes, it can. And now maybe this is not the appropriate moment, but I have a trade room that today, by the way, is the last day for a promo price. But I have a trade room. And yes, I use these every day. And that's how we trade. And so, yes, it's very functional on an intraday basis. And I trade off of a 2-minute, a 5-minute, and a 15-minute chart. And I'm using everything I just told you. Because Elliott is Elliott. Fibs are fibs. Whether I'm connecting it on a 2-minute chart, yes. How reliable? Very, very. You can figure out real quick what your fibs are going to be and what the extensions are going to be. And when it starts to go through, it is remarkable. I got to be honest with you, it is remarkable. What can flip that around is if you don't accept it. If you don't think it's like, well, this is all algorithmically controlled and they're just moving in as buyers or they're moving in as sellers. Now, one other thing that I will say, which has nothing to do with fibs or Elliott, in a way it does, but in a way it does not. There's a lot of options being traded in the United States. Trillions of dollars worth of options. We have expirations on M2, on the SPX. Well, Sam, it's a little bit hard for me to flip over to that chart and do it because it's on a different computer. Okay, the recording is going to stop. So I've got to wind this up. Trade room.
Ignore that. That's someone
Oh,
posting
okay.
that. That's not real.
Okay. But I know that I got 6 minutes. So just to kind of go with the trade room, www.logicalsignals.com, hit the trade room button. That'll explain the whole thing. If you had an interest, we meet every day from 6 a.m. to 8 a.m. Pacific. I provide daily updates and morning updates on the S&P, on the ES, and the NASDAQ, the NQ. But what I want to mention here is the options trading is gigantic. And do you think it does not have a control on the markets? Think again. It truly does. How? Because you've got dealers that have to sell or buy these options because they're providing the market, and then they have to hedge. How do you hedge? You buy or sell the underlying. So it happens in the stocks, it happens in the SPX. For example, last Friday was the September expiration, monthly expiration. The value from the SPX alone, now mind you, it was very, very call heavy, but the evaluation, the nominal value of that expiration, $1.1 trillion. And most of that expired on the opening because the SPX on the monthly chart, on the monthlies, has an AM expiration and a PM expiration. Now, when I got to tell you that when you're looking at an option, get an understanding of what gamma is, theta, and how it affects a position. So what I also follow is where gamma levels are being built up. Where does volatility get triggered into action, into high gear? And there are companies that actually can produce those levels, gamma levels, volatility triggers, and that's what they do. It's their business. And there's one that I use, is extremely dependable. And when these levels get broken, because we're algorithmically controlled, it isn't people pushing that button, it's the algorithm that says, that broke, this is my order. This is what I've been programmed to do. And they jump into action. Why? Because usually, if it's going through something, the positions that are there are going to need to be adjusted because your gamma, positive or negative, is going to work against you accordingly to the move. So these big, big trading firms and large traders, including the market makers or the dealers, they've got to make quick moves. And those produce incredible moves in our market. And you just think, well, we're just dying. We're dying on the vine. It's like, yeah, it's called adjusting. Today's a Friday expiration. So we go through on a Friday expiration, we're looking at tons of algorithms that are going to make adjustments. We have large firms that will move a market down to a certain level. Why? Because they're trying to monetize either a call or a put. And when they're done, that expiration is done for them. They move on. Each one of these things, when they happen, though, I'm not sitting there going like, well, that's bullish, that's bearish. I'm thinking about, okay, I'm going to buy it or sell it because I'm going to make $1,500. I can do that just scalping. So I try to remove the emotions. Sometimes it works, sometimes it doesn't. But I'm going to wrap this up. First of all, thank you very much for hanging out with me, for listening. I hope that I have presented some things that were useful. Here's what I do. I provide a daily and a morning update on YouTube. I have memberships on YouTube. And so you can reach me right there. That's my website, logicalsignals.com. You can find out about my trade room. Today's the last day for the promotional price. And also, you can email me, michael@mgf1partners.com. Ask me a question. Just if you want to have a talk, go ahead and email me. I welcome that. I enjoy engaging with others that have an interest in Elliott. I also do coaching. I do coaching trading. I do coaching on Elliott, and I do coaching on Fibonacci. I do coaching on mindset. These are all the things that are vitally important. And now I'm going to wrap that up and say thank you again. Thank you, Anka. Thank you, David, for inviting me here today. And folks, you don't want to miss the next person that's online.